We are back in the black hole of real estate, and the Fed dropped rates a quarter point at the final meeting of 2024. And you're wondering, how is this going to affect you? This is your host, Ron Wysockarski, and I'll be honest with you, I'm not sure that's going to help you out if you're looking for lower interest rates for mortgages. You know, we saw this play out in the last meeting, in November, where the rates went down. The federal funding rate went down, but the mortgage rates went up. And a lot of pricing in has gone on this year as where the banks thought rates were going to go. And the kicker here is that even though the interest rate that banks are charged to borrow money in the overnight counters is greatly impacted by how the banks feel about the direction of inflation. And that's tied into the job reports and a bunch of other things that may or may not interest you. But it's absolutely a case that is likely to play out once again, is that even though it's less expensive for banks to borrow money from the Fed, and it's 1% less expensive over the last several months because there was a 0.5% drop, a quarter, and then a quarter, so it's 1% cheaper for them to borrow money, and yet the interest rates are about the same or even a little bit higher than when this started. So let's just say that inflation, the economy, job reports, and anything else you want to mix in the soup has caused banks to be far more conservative and a little nervous about lending money and dropping rates. So I don't know that latest drop is going to lower interest rates. Matter of fact, I think it isn't. So what would make interest rates come down? Well, certainly another drop at the Fed could help, but I believe it's the other things I mentioned that will actually help more. So as the economy grows and the job reports become even more positive than they are with some, maybe something to verify it, because there is some mysticism going on where people feel that the job reports have been inflated in some respect. I'm not the person that's going to fact check on that, sorry. But there is a lot of sentiment out there that there's been some fudging of the numbers. We'll leave it at that. I would also say that as inflation truly gets tamed, I think that will help. There is a lot of talk about what's going to happen after the inauguration. And I believe that the tariff talk is certainly affecting things because it creates uncertainty. And it's for someone smarter than me to decide if tariffs are the right way to take, that approach to bring more jobs to the U.S. and to do other things. And if it all works out and there's more American jobs that pay more money and it helps this economy over here, it makes all the businesses more profitable and more money for people to buy and sell homes, well, then maybe it's a really good strategy, for the United States. And it might just be. But interest rates being a mix of many factors, I think as people have more money and more willing to spend it, I think that will spur things. And I do think you'll see rates come down as businesses get busier, because it would be good business for the banks. At some point, someone's going to be anxious to get more mortgage business in, and they'll drop the rate, and likely others will follow, or they'll just gain a lot of market share. Some CEO of the bank is going to want to gain some market share, and they're going to get aggressive. We don't know which one it's going to be, but somewhere is going to get aggressive on that, and that will help the rates come down. I could absolutely flip it the other way and say, look, things are kind of crazy, and there's vast uncertainty, and we're worried about, the funding of the federal government. Every year this happens. We should be used to it by now. But if things slide in the wrong direction or something terrible happens, well, then maybe rates stay where they are or go higher. My suspicion is that eventually rates will come down, but probably not in the next 30 days, even though the Fed just went down for the third time in as many sessions. So we've talked about this in one or two other shows, and I want to really come back to this. So how do you defeat the high interest rate, or at least what feels high? Historically, it's not a high rate. 6-7% is probably what the average has been. We've just enjoyed super low rates for a long, long time. in the last year we've gotten a little cranky because they're back where they used to be. Okay, so setting that aside, what could happen? On other shows, I've talked about the 2-1 buy down. So if you're familiar with that, or maybe you missed it, very, very briefly, a 2-1 buy down, it's going to allow you to get 2% cheaper in the first year of a mortgage, 1% cheaper in the second year in the mortgage, and the difference between the payments that you might have made and actually made, you add up that number, and it's paid at closing when you buy the house. And for someone who's trying to qualify for a home, maybe saving a couple $100 a month on a payment might allow them to qualify for the home that they want. The 2-1 buy down it's been around for a long, long time. The buyer can pay for it, and let's say they've got extra money on hand at closing, but their income is such that they don't qualify for the house they want. That could drop the payment down. You can also ask the seller to pay for it in order to get the deal to go through. Maybe the seller's motivated to help out with that, so seller can pay some closing costs. And then with the banks, willing to refinance, so many of them, 3-5 years down the road, give you some interest rate protection and refinance with no lending fees. That is one way to manipulate your moment of how do I defeat these interest rates that feel high right now. Until the Fed rate comes down in such a way that's in concert that the mortgage rate also comes down. So if you want to buy on today's rate but pay a little bit less or a lot less, then the 2-1 buy down can help you, and then refinance down the road with no lender fees. That would help. And that might be a solution for someone who really wants to buy right now but is holding off because the rates are higher than they would like, or higher in such a way that they don't qualify for the house that they want. So, my recap is pretty simple. I don't think that the Fed rate coming down is going to help with regard to lower interest rates to make the monthly housing payment more affordable. I think we can use some other tools to do that. We've talked about the 2-1 buy down. We've talked about being able to refinance with no lender fees at a lot of banks right now, and then paying points. You could also pay a point. It's 1% of the mortgage rate, not the purchase price. So if you're someone that was putting a pretty good chunk down in a house, if you bought it for $350 and you're putting 20% down, you're already putting $70,000 down. For a point, would be 1% of the mortgage balance. So if you paid $400 and your mortgage amount was $320, right? 1 point is $3,200. That might make your interest rate come down 0.25%, which my suspicion is you get that money back in the first year or two, which for most people is a good bet. So you could absolutely do that. You can ask the seller to give you a concession at closing, and you can use that to pay that point as well. You could pay a point, do a 2-1 buy down. There's a lot of things you can do. What if you paid a point to get the rate down a little bit, and then did a 2-1 buy down to get it down even more? That's probably within the 3% allowable in most cases for seller concessions. So that would be a double whammy to push the rate down until they eventually get lower. So if we're looking for ways to manipulate that interest rate until it gets to one that's more palatable to you, that's a way to do it. Well, now I've just described a scenario to you where it's going to cost, $5,000, $10,000 to get the rate down and the payment down to where you like it. And you're like, well, whoa, hey, pump the brakes. I can. But let's just suppose that homes go up in the next year at a nominal 3%. Pretty normal rate of 3% increase. That $400,000 home is going to go up $10,000, $12,000. So if you can own it now and pay the fee to get the payment where you want it now with a chance to refinance it, and you get the seller to pay for it, it seems like a win all the way around. The seller gets to sell, you get to buy, you get a better price today than you get next year, but you'll pay the payment as if the rates had already come down. Now, here's the really good part. What if we know that we can pay a point? What if we know we can do a 2-1 buy down? And what if, while we're looking at homes, it takes a month or two and the rates come down too? Well, there's 3 good things for you. So will the Fed rate coming down help you out? Not necessarily, probably not right now, but I'm here to help. And now that I've given you a strategy, pay a point, do the 2-1 buy down, and make sure that you can refinance with no lender fees down the road. And then you can go do your home shopping. I hope this helped you out. This is Ron Wojciechowski for the Black Hole of Real Estate.